Welcome back to the Deep Dive. Today we are wrestling with, well, one of the most dramatic turnaround stories in corporate history.
That's putting it mildly.
We're talking about a company once synonymous with industrial failure, Eastman Kodak, ticker KODK.
Yeah, and it's not just a turnaround story, it's practically financial theater. On November 7, 2025, Kodak's stock price surged.
A huge surge.
A massive 33% in a single day, landing at $7.79 a share. I mean, that kind of single-day move, it just demands immediate attention, doesn't it?
Absolutely. And here's the essential conflict that really frames this deep dive for us today.
Okay.
Just 3 months before that massive surge, Kodak filed documents. Documents explicitly stating there was substantial doubt about Kodak's ability to continue as a going concern.
Wow, that's about the most severe warning a public company can possibly issue, short of actually filing for bankruptcy itself. It's serious stuff.
It really is. So our core mission today is to analyze the mechanics behind that sudden shift. How on earth did management resolve an a liquidity crisis in less than 90 days?
And maybe more importantly, is this dramatic rally sustainable? Is it based on real, lasting operational improvements? Or is it, just clever financial engineering buying them a bit more time?
Exactly. So this deep dive is going to be a fundamental sort of owner-operator style analysis. We're relying entirely on the explosive information that came out of the Q3 2025 earnings report.
Right, going beyond the headlines.
We are looking at the business quality, the management performance under, frankly, extreme duress, and trying to figure out the true intrinsic value here.
And what makes this so fascinating, I think, is that we have these two really powerful narratives just clashing head on.
Yeah, tell me about it.
On one side, you've got management delivering this $600 million cash injection. Huge news. And it eliminates that immediate threat of insolvency.
The going concern issue resolved.
Right. But then, on the other side, there's this massive external regulatory threat kind of lurking in the background. A looming 50% tariff?
Which sounds bad.
It's potentially devastating. It's quietly threatening to just wipe out the profitability of their largest business segment. So a real contradiction there.
Okay, so it's a classic high-stakes puzzle. Let's unpack this monumental pile of information. Try to figure out if Kodak is truly fixed or if this is just, a temporary reprieve.
Sounds like a plan. Let's dive in. Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding.
Okay, so the first thing, and maybe the most crucial mental shift any listener needs to make, is getting that the Kodak of today. Well, it bears almost no resemblance to the company maybe your grandparents knew.
Right, forget the yellow film boxes.
Exactly. This isn't about consumer cameras anymore. Today's Eastman Kodak is really a global B2B manufacturing and, importantly, chemicals powerhouse.
And that shift, that really defines the whole investment thesis, doesn't it? It's kind of a race between two core segments, and each one is telling a radically different story, operationally speaking.
That's right. You've got the legacy business, which is the print division. In Q3 2025, that was still the revenue backbone, generated $177 million.
Still the bigger piece.
Still the bigger piece, but, and this is the key point, that revenue is shrinking. It was down 3% year over year.
Okay, so the legacy side is declining. That forces investors, I suppose, to look entirely towards the other segment, the growth engine.
Precisely. The designated growth engine, advanced materials and chemicals, or AM&C. Now, that segment only brought in $82 million in Q3 2025.
Smaller, but growing.
Much smaller, but showing robust double-digit growth. It was up 15% year over year. So the entire bullish case, really, it rests on AM&C scaling up fast enough to stabilize or maybe even reverse the decline of that larger print business.
Got it. So let's dig into what actually drives these segments. The print side, you mentioned its legacy, but it relies on that classic razor and blade model, right?
Exactly. A classic competitive moat strategy. The razor here is sophisticated machinery things like the Kodak Magnus plate setters, and they've sold a lot of these, over 26,000 machines since 1995.
Wow, that's a huge installed base.
It is, and that installed base becomes their captive audience, you see. The high-margin recurring blades are the consumable inputs.
Ah, the things they have to keep buying.
Right. Proprietary aluminum lithographic printing plates, along with workflow software like their Prenergy system. Once a big commercial printer, or say a newspaper, is reliant on Kodak's specific plates and software for their presses.
It's hard to switch.
It is. The cost and just the hassle of switching to a competitor creates these sticky, maybe modest, but definitely real barriers to entry. That proprietary element is key to their margin stability, or at least it was.
Okay, was being the operative word there. But the excitement, and really the future, if there is one, it seems to be entirely in this AM&C segment.
That's where the focus is shifting, absolutely. Beyond things like industrial film for motion pictures and X-rays, the really transformative pivot is their entry into, get this, cGMP pharmaceutical manufacturing.
See,
Yeah, current good manufacturing practice. They now possess an FDA-certified facility dedicated to manufacturing regulated pharmaceutical products.
okay, that sounds significant. FDA certified isn't easy.
It's a monumental detail, and it speaks volumes about the quality of their underlying assets and their intellectual property. I mean, entering the pharma space, it's high margin precisely because it's high barrier to entry.
Makes sense.
That FDA cGMP certification, it isn't just some label they slap on. It means their facilities, their processes, they're all validated to ensure the quality, the identity, strength, purity of every single regulated product they make.
So it provides real assurance.
Huge assurance. And that level of quality control and regulation instantly separates them from, your standard chemical manufacturers.
And presumably this leverages their old strengths, that material science background.
Exactly right. It leverages their enduring competitive moat, which is rooted deep in material science. Remember, the company holds something like 79,000 worldwide patents.
79,000.
Yeah, a legacy built over 130 years of R&D, all centered on this specialized chemical coating and layering expertise. That technical skill, it turns out, is transferable. From coating photographic film way back when to coating precise layers needed for complex pharmaceutical synthesis today.
Fascinating. And they need the physical infrastructure for that too, I
Yeah,
imagine.
absolutely. This pivot is made possible only because they have this massive integrated physical infrastructure. Specifically, that sprawling campus they have up at the Eastman Business Park in Rochester, New York.
Right, the old headquarters.
You can't just decide one day to pivot into complex chemical manufacturing or, FDA-regulated processes without having immense established infrastructure and that deep internal expertise already in place.
Okay, so let's look at the industries they're playing in now. The contrast seems pretty stark. Print is.
Mature. Highly fragmented, struggling desperately with the whole digital transformation thing. It's a huge market, sure, about $531 billion globally.
But not growing much.
Barely. Growth is slow, maybe 5.25% CAGR if you're optimistic, and margins are constantly under pressure.
And why is that? Just digital taking over.
Well, that's part of it, definitely, but the problem is really twofold. You've got digital eating into demand, yes, but you also have raw material inflation pushing up their costs significantly.
Like paper and aluminum.
Exactly. The CEO himself has publicly warned that this persistent inflation in raw materials like specialized paper and particularly aluminum for the plates is threatening to make print basically a luxury good.
That's not good for a volume business.
Not at all. And they're competing directly with giants. Think Fujifilm, Canon. Companies that often operate with vastly lower, sometimes vertically integrated cost structures. It's a tough fight.
Okay, so print is tough. But the AM&C division, that's where the growth story is. Where does that put them?
Well, that puts Kodak squarely into the global specialty chemicals market, which is also massive, but crucially, it's growing at a much healthier clip, maybe 6.7% CAGR, and certain segments, like green chemicals, even faster at nearly 8%.
And you mentioned Fujifilm earlier.
Yes, this is essentially the Fujifilm playbook.
Explain that.
Well, Fujifilm, Kodak's old arch-rival from the film days, successfully leveraged its own material science expertise years ago. They transitioned away from dyeing consumer film into high-margin businesses. Think medical imaging, specialty chemicals, pharmaceuticals.
So Kodak is following in their footsteps.
Clearly following that same successful strategic path. And that FDA cGMP certification we talked about. That's the key regulatory barrier. It makes this pivot serious and, importantly, insulates them from easy competition by, say, pure commodity chemical players like BASF or Dow, at least in those high-value specialty niches they're targeting.
Okay, so that's the business model in a nutshell. A fading legacy, hopefully funding a high-growth, high-barrier hope for the future.
That sums it up pretty well.
But who is steering this ship through such, intense turbulence? Let's turn our attention to the management team.
Chapter 2, Management Evaluation.
Right, because in a high-stakes turnaround scenario like this, management capability, it's often the single most important factor, isn't it?
Absolutely critical. And the market just gave CEO Jim Continenza, who's known as a turnaround specialist, by the way, and CFO David Bullwinkle, he's a seasoned Kodak veteran,
They got a huge vote of confidence.
a massive, instantaneous vote of confidence with that 33% stock surge. The market basically said, okay, we believe you pulled it off.
And their leadership was immediately tested, wasn't it? By that defining crisis back in August 2025.
Oh, yeah. The filing of that 10Q containing the substantial doubt about Kodak's ability to continue as a going concern, I mean, that was a legally required acknowledgement of impending insolvency.
What did it mean practically?
It meant they had massive debts, specifically around $497 million, maturing within the next 12 months. And crucially, they simply didn't have the current liquidity, the cash on hand, to pay it off when it came due.
That is the definition of a financial ticking clock.
Absolutely. So the resolution, which they delivered just 90 days later in that November Q3 report, that was the bombshell that stopped the clock. Management explicitly stated, quote, going concern conditions have been fully resolved.
Wow. 90 days from maybe bankrupt to fully resolved. How?
Through some pretty extraordinary financial maneuvering, specifically a complex transaction involving their pension plan.
A pension reversion. Explain that for us.
Sure. So basically, Kodak's main pension plan was significantly overfunded, meaning it had more assets than needed to cover all its projected future obligations to retirees.
Okay.
This transaction essentially allowed the company to legally reclaim that surplus cash, and it turned out to be a whopping $600 million, which was actually $100 million more than their initial estimate.
So they got cash out of their own pension fund. Is that allowed?
It is, but it's complex. They first had to ensure all the required legal and fiduciary obligations to current and future retirees were fully met and secured, often by purchasing annuities or setting up a separate secure fund. Only then could they access the true surplus.
Okay, that sounds like skillful management, navigating all that.
Extremely skillful. It required navigating really intricate regulatory hurdles, actuarial complexities, all under immense pressure. And the result was this instant, massive capital injection that directly addressed the immediate debt threat.
Incredible. But here's where we get into maybe the most powerful signals, right? Regarding management's own confidence.
Yes, this is really interesting. We need to acknowledge the transparency, but also the paradox here.
How so?
Well, while they were legally required to issue that dire, frankly, fear-inducing going concern warning back in August.
Which tanked the stock, presumably.
You bet. But at the exact same time, CEO James Continenza and one of the directors, Philippe Katz, were personally buying shares on the open market.
Okay, hold on. I have to challenge that, though. When a company basically issues a death warning and the insiders are buying, why isn't that viewed more cynically? Doesn't that seem ethically questionable or maybe even border on insider trading?
That's a really critical question, and it speaks to the nuance of these regulatory filings. Management was legally obligated to report the risk based on that debt maturity timeline and their current cash position. That's a fact they had to disclose.
Okay.
However, they internally possessed the strategy, the pension reversion plan, and they clearly had high confidence that this plan was imminent and would fully resolve the liquidity issue. So when they bought shares, the argument is they weren't acting on non-public material information about, say, business performance suddenly getting better.
They were betting on the financial maneuver.
Exactly. They were expressing extreme confidence in the success of the financial maneuvering they had already set in motion. It's arguably a massive bullish tell. They were personally betting their own money on their own crisis resolution plan, right at the point of maximum public fear and pessimism.
So they weren't betting that, Q4 profits would suddenly boom. They were betting the balance sheet maneuver would succeed and instantly re-rate the stock.
Which is exactly what happened.
Okay, that does provide a strong sense of alignment with shareholders, I suppose.
It certainly appears that way. Now, moving to capital allocation, their strategy seems laser-focused, which is exactly what you want to see in a turnaround, right?
Absolutely. Survival first.
Survival first, then rapid deleveraging, and funding only the highest return growth projects. Priority number one is clearly using that cash to pay down that $507 million debt target. Get rid of the immediate threat.
And priority two must be funding that AM&C pivot, making sure that pharma facility scales up.
Correct. Making sure the cGMP facility is fully operational and scaling. They also made some efficiency investments in print, like their Sonora plates, to try and lower costs there. But crucially, as you'd expect, they pay no dividend on the common stock.
Which is the right call.
Yeah. Absolutely the correct, prudent decision for a company in this situation. Paying a dividend while facing a liquidity crisis, even one they just solved, would have been reckless. Every dollar needs to be retained right now to reinforce the balance sheet, fund that transition, and prove they can eventually get to free cash flow positive sustainably.
Makes sense. Now, let's look at efficiency metrics. Return on invested capital, ROIC. That's a key measure of how well management uses the money they have, right?
Yes, a very important one.
And it currently sits at a pretty mediocre 4.92%. That seems low.
It is low, and it reflects the capital-intensive nature of that legacy print business, which requires huge physical assets, but as we discussed, generates pretty low returns these days.
So the bull case needs that number to improve.
Significantly. The bull case hinges on a significant mathematical improvement in that ROIC figure. Remember the basic formula. ROIC is return, like net income or EBITDA, divided by invested capital, which is basically debt plus equity.
Okay.
So when management takes that $600 million cash infusion and uses it to wipe out over $500 million in debt,
They shrink the denominator.
they dramatically shrink the denominator, the invested capital base, which means even if the operational return, the numerator, stays flat for a bit.
The ROIC ratio instantly looks much better.
Exactly. And then if the high-margin AM&C segment starts to scale up and contribute more profit, while that invested capital base is now smaller, the ROIC could potentially double or even triple relatively quickly, making the company look fundamentally healthier on paper very fast.
So the financial maneuvering isn't just about survival, it's also about improving those key metrics.
Precisely. It's designed not just for survival, but to make the core business metrics look fundamentally more attractive as, hopefully, that high-margin growth takes hold.
That really clarifies the mechanics of the pivot. It's both financial and operational.
And by the way, if you're enjoying this deep dive, really getting into the weeds of how this turnaround works, make sure you like and subscribe to Stock Analytics AI.
Yeah, we're digging deep today, connecting the dots between crisis and cash flow, but we're always looking for new company stories to unpack.
And for just $4.99 a month, you get access to over 500 deep dive videos covering all the S&P 500 stocks. We've got the NASDAQ 100 coming up next, plus you get members-only requested deep dives. Check it out.
Chapter 3, Financial Health.
Okay, let's translate that management maneuver we just discussed into the hard numbers. The numbers that actually drove that incredible 33% stock jump.
Right, the market reaction.
So the current market capitalization, based on that $7.79 price, and about 89.8 million shares outstanding, sits at approximately $699.5 million. Call it $700 million.
And historically, revenue has been, well, not great, declining and volatile.
That's fair. It peaked around $1.2 billion back in 2022. The TTM, or trailing 12 months, revenue is now about $1.05 billion. So yeah, this multi-year downward trend is precisely why that consolidated Q3 growth number, even though it was a modest 3.07%, was such a massive sign of relief for the market.
Because it suggests the bleeding might be stopping.
Exactly. It suggests that the 15% growth we saw from AM&C is finally starting to, bend the curve on that overall revenue decline. The first green shoot, maybe?
But the real story, the margin miracle, as the outline calls it, that's what really moved the stock.
Absolutely. The true miracle that the market reacted so violently to was the massive jump in margins. Gross margins surged to 25% in Q3 2025.
25%. From what?
Well, that's an enormous jump. It was up a full 8 percentage points compared to the same quarter last year. 8 points.
Wow. For an industrial B2B company like Kodak, 8 percentage points is monumental. How much of that was external factors like maybe raw material costs dropping versus internal stuff like management successfully pushing through price hikes?
It looks like it was a combination, actually, which in a way demonstrates management's agility on both fronts. They did successfully implement price increases on their proprietary plates, leveraging that stickiness we talked about.
Yeah.
And they also seem to have benefited from at least a temporary stabilization or even drop in some key raw material costs during that quarter.
And that combination flowed right down.
Straight down to operational profitability. Operations flipped dramatically. They went from an $8 million loss in Q3 of 2024 to a $19 million operating profit in Q3 of 2025. That is a $27 million positive swing in just the core business performance year over year.
Okay, huge operational improvement. Now, here's the point that apparently confused some media headlines. JAP net income, the bottom line number, actually decreased. It went down to $13 million. How does that work? if operations were so much better?
Ah, yes. This is the aha moment. This is what the sophisticated segment of the market, the pros, recognized immediately while maybe headline readers got confused.
Oh, what was it?
The decrease in GAAP net income was purely, and I mean purely, non-cash accounting noise related to that pension plan we discussed earlier.
Okay. How?
Well, last year in Q3 2024, they reported a large non-operational income item from the pension plan, about $42 million. This year, in Q3 2025, that non-cash income figure dropped significantly, down to only $16 million.
So it wasn't a real operational decline, just less pension accounting income.
Exactly. The market correctly ignored this noise because it has absolutely nothing to do with the underlying health of selling printing plates or manufacturing chemicals. It's an accounting artifact.
Got it. So the cleanest measure then, the one that strips out that noise and shows the core business improvement, would be operational EBITDA.
Precisely. And operational EBITDA swung dramatically. It went from a really weak $1 million in Q3 2024 to a very robust $29 million in Q3 2025.
$29 million.
Yes. This confirms that the operational turnaround, at least in that quarter, was absolutely real and quite significant.
Okay, operational strength is there. Now, despite that, we still have to address the persistent weakness, right, which is cash flow.
Correct. Free cash flow, or FCF, has been historically negative for Kodak. And even in the first 9 months of 2025, despite the improving operations in Q3, they still had an overall FCF burn of $37 million.
Meaning they spent $37 million more than they brought in.
Yes, covering operating activities and necessary capital expenditures. They spent $37 million more than they generated.
Okay, that cash burn, that's the cold, hard reason why that going concern crisis was so real back in August. They were literally running out of working capital fast.
Exactly, which underscores why that $600 million pension reversion is not some kind of profit windfall to be celebrated on its own. It is a true lifeline. It's a temporary capital cushion.
To fund the ongoing burn.
To fund that ongoing FCF burn. And, crucially, buy them the time they desperately need to scale up the AM&C business to profitability and hopefully achieve sustainable FCF positivity for the whole company.
Right. It buys time. Okay, and this leads us directly to the mechanical fix on the balance sheet itself. The debt-to-equity ratio you mentioned was high.
It was high, yes, sitting at 1.59 before this Q3 news, signaling significant leverage risk. But as we discussed, this number is now basically obsolete.
Because of the cash infusion.
Right. Using that $600 million in cash to pay off the targeted $507 million in debt will instantly collapse this ratio down to a very low, very healthy level. It removes almost all the balance sheet leverage risk overnight.
And the ultimate smoking gun of the crisis, you said, was the current ratio.
Yes, the current ratio. It measures a company's ability to meet its short-term obligations bills due within a year. A ratio below 1.0 is a huge red flag for immediate liquidity risk.
And Kodak's was?
Kodak's was a perilous 0.79, almost entirely driven by that looming $497 million chunk of short-term debt that was about to mature.
So paying that off.
Paying off that $500 million short-term liability instantly fixes the current ratio. Pushes it well above the safe 1.0 threshold. It removes the immediate liquidity crisis entirely. And that specific balance sheet fixed the removal of the imminent bankruptcy risk is what fundamentally justified that massive 33% stock rally.
Okay, the market saw the bankruptcy risk disappear and repriced accordingly. Makes sense. So if we try to put a value on Kodak now, post-fix traditional metrics don't seem very helpful.
They really don't. The price-to-earnings PZ ratio is unusable because their trailing 12 months earnings per share are still negative. The price-to-sales PS ratio is low, around 0.67, but that's pretty typical for a heavy industrial company with historically low margins. So yeah, relative metrics aren't telling us much here. We have to go fundamental.
Which means using a discounted cash flow model. A DCF.
We really have to. It becomes a special situation valuation exercise. A DCF tries to estimate intrinsic value by forecasting all the company's expected future free cash flows and then discounting them back to their present value.
And a DCF for Kodak sounds uniquely complex.
It is, because you're essentially modeling two distinct businesses that are moving in completely opposite directions inside the same company. You've got the potential 10-15% growth from AM&C fighting against the likely 5-10% perpetual decline of the much larger print business. Forecasting that net effect is tricky.
But here's where the market physics of that huge rally become really clear, right? You're saying the most critical driver wasn't just the $600 million cash itself.
No, it was the impact that cash had on the required discount rate.
Explain that connection.
Okay, so the discount rate in a DCF is essentially the rate of return investors demand to compensate them for the risk they're taking. Higher risk means investors demand a higher potential return, so they use a higher discount rate.
And before the news.
Before the news, with bankruptcy genuinely looming, analysts had to use a massive discount rate for Kodak, maybe 15%, maybe even higher, reflecting that severe financial distress. Every dollar of potential future cash flow was drastically discounted because there was a real chance the company wouldn't survive to generate it.
But once the debt is resolved by the cash infusion,
The immediate risk of failure evaporates. The company transitions instantly from distressed potential bankruptcy to turnaround story. It's still risky, but a different kind of risk.
a low risk profile.
A significantly lower risk profile. And that lower risk allows analysts to immediately drop the discount rate they use in their models, maybe down to a more standard range for an industrial turnaround, perhaps somewhere between 9% and 11%.
And mathematically, lowering the discount rate in a DCF.
Has a massive positive impact on the calculated present value, the intrinsic value estimate. All those future cash flows are now discounted less severely, making them worth more today. So that 33% stock surge, you can see it as the market efficiently and instantly lowering its required discount rate in real time, reacting to the removal of that existential risk.
Okay, that makes perfect sense. So based on an educational DCF model one that integrates this debt payoff, uses a now lower discount rate, and models those conflicting segment growth rates, what kind of value range does that suggest?
Well, running those kinds of numbers, again, for educational purposes, suggests an intrinsic value range for Kodak shares roughly between $6.50 on the lower end and maybe $9.50 per share on the higher end.
And the stock jumped to $7.79, right in the middle of that range.
Exactly. It suggests the market, despite the violence of the move, appeared to have acted quite rationally in its repricing. Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, Market Sentiment.
Now, what's also fascinating about this huge rally is that Kodak was, and you could argue largely remains, something of an orphan stock.
Meaning not covered by Wall Street.
Pretty much. There are currently no analyst price targets out there, no formal consensus ratings like buy or sell. Wall Street had, for all intents and purposes, kind of left the company for dead, given up on it.
And that lack of coverage, that actually creates the perfect precondition for massive mispricing, doesn't it?
It absolutely does. When you don't have analysts constantly tweaking their models and price targets based on every little bit of news, the market sometimes has to discover significant changes on its own.
And the reaction is delayed, but then sudden.
Exactly. The correction, when it finally comes, tends to be sudden and violent, which is precisely what we saw with that 33% surge in one day. The market playing catch-up. Big time.
We also saw a great example here of the difference between, say, media headlines and sophisticated market reaction.
Oh, definitely. The media generally describe the Q3 results as mixed. Why? Because they fixated on that decrease in GAAP net income that we already dissected.
Right, they missed the forest for the trees.
Completely. But the market, driven by, sophisticated institutional funds, maybe algorithms, they were clearly reading the footnotes.
They saw the real story.
They ignored the non-cash pension accounting noise and focused entirely on the crucial factors: the balance sheet fix, the resolution of the going concern warning, and that explosive $29 million operational EBITDA number. The market demonstrated true clarity here, in my opinion.
Wow, so?
Well, it punished the stock severely when the bankruptcy risk was highest, pricing it for potential failure. And then it instantly repriced it upwards the moment that specific risk was demonstrably removed. Pretty efficient, even if brutal.
And adding fuel to that fire you mentioned was the short interest.
Yes, significant short interest. Before the news hit, short interest sat at a very high 9.81% of the total float. That's a lot of professional traders actively betting against the company, betting on the bankruptcy thesis playing out.
And that thesis was just completely invalidated overnight by the $600 million lifeline.
Totally invalidated. So those short sellers were suddenly trapped. Their reason for being short disappeared. They were forced to buy shares back immediately in the open market to close out their losing positions.
Which creates massive demand.
Massive immediate demand for the stock. That forced buying, what we call a short squeeze, undoubtedly contributed significantly to the sheer speed and velocity of that 33% surge. It wasn't just fundamental re-rating, it was technical buying pressure too.
And technically speaking, the charts now confirm this shift.
Oh, absolutely. The price surge to $7.79 decisively broke Kodak above two critical technical levels that chart watchers pay close attention to.
Which are?
The 50-day moving average, which was sitting down at $6.29, and the 200-day moving average, which was around $6.41.
And breaking above those is significant.
Very significant. For listeners maybe unfamiliar, when a stock trades strongly above those key long-term averages, especially by 20% or more, as Kodak did, it signals a powerful and potentially decisive shift in momentum and trend. It indicates that the previous long-term downtrend has likely been forcefully reversed by this sudden influx of positive fundamental news. The bulls have taken control, at least for now. Chapter 5. Ownership structure.
Okay, so who actually owns Kodak now?
Yeah.
Looking at the ownership structure, institutional holdings seem pretty significant.
They are. They sit somewhere between 41 and 46% of the total stock. And this includes, the usual suspects, the major passive index funds like Vanguard and BlackRock that have to own it because it's in certain indices.
Like stats of money.
But more importantly, perhaps, it also includes active, often event-driven funds. For instance, a fund called Marshall Wace reportedly increased its position in Kodak by over 50% during Q2 2025.
Before the crisis hit its peak.
Yes, in the quarter leading up to the August going concern warning. This suggests that some elements of the smart money might have already been positioning themselves, perhaps betting that some kind of volatility event or maybe a balance sheet restructuring was becoming more likely even before it became public knowledge.
Interesting. And this brings us back again to that critical insider signal, the buying by the CEO and director. We can't emphasize that enough, can we?
No, I think it's arguably the most powerful signal in this whole story. The fact that CEO Continenza and Director Katz personally purchased shares with their own money in August 2025.
Right at the moment of maximum fear.
Exactly. At the very moment the company was legally mandated to file that terrifying going concern warning, they were buyers.
Yeah.
It remains the strongest possible statement of management's confidence in their own turnaround plan.
And it implies that deep alignment with common shareholders you mentioned.
It really does. They were personally invested financially in the success of the turnaround plan right when external fear was at its absolute peak. Furthermore, it's worth noting Continenza maintains a significant direct personal stake in the company, reportedly around 1.9 to 2.1%.
So he has serious skin in the game.
Definitely ensures his long-term financial success is tied directly to the stock price appreciation alongside other shareholders. Ownership seems relatively diffuse beyond that. No single controlling entity.
Chapter 6. Risk assessment.
Okay, no turnaround story is complete without a really rigorous look at the risks that remain, even after the big fix. Let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. Starting internal with strengths.
Strengths seem clear.
Yeah.
That huge patent portfolio, 79,000 patents, proven ability now to execute under extreme crisis pressure, and those unique, high-barrier physical assets, especially the cGMP facility and that core material science expertise.
Agreed. Now, the weaknesses are equally potent, though. That legacy print division still represents 2/3, about 66% of their quarterly revenue. And it's still shrinking. That's a huge drag.
And the cash burn.
The cash burn, absolutely. The company is still burning cash overall. Remember that negative $37 million free cash flow over the first 9 months of 2025. That means the $600 million lifeline, while massive, is ultimately finite. They need to reach FCF break-in before it runs out.
And the competition.
And management themselves admitted they compete against rivals in print who have structurally lower cost structures. That's a major, major concern for long-term profitability in that segment.
Okay, what about opportunities, external factors?
Opportunities seem centered on two main areas. First, obviously, the massive potential if they can successfully execute that pivot into high-margin pharmaceuticals and specialty chemicals via AM&C. That's the whole growth story.
And second
is the newfound optionality created by having a newly clean, almost debt-free balance sheet. They now have the financial freedom, the flexibility to potentially invest more aggressively in organic growth, or maybe even make smaller strategic niche acquisitions that could accelerate that AM&C pivot. They have choices they didn't have before.
Right. Now, threats. General threats include things like continuous digital disruption in print, intense competition from the huge chemical giants in AM&C, and just general commodity price volatility for their inputs.
And macroeconomic threats were huge just a few months ago. Inflation in paper and aluminum directly threatens those print margins, as we discussed. And high interest rates were an absolutely existential threat
How so?
because they made refinancing that huge chunk of maturing debt nearly impossible, or at least prohibitively expensive. That's partly why the going concern warning happened.
But the pension reversion fixed that.
Completely neutralized the interest rate threat, at least regarding that specific debt pile. By allowing them to simply wipe out over $500 million of debt, they no longer have to worry about refinancing it in a high-rate environment. They just eliminate the liability altogether. That might be the greatest hidden long-term benefit of the Q3 news removing that rate sensitivity.
Okay, but that brings us to what you call the new core bear case, the tariff time bomb. This sounds like a very specific, massive external threat.
It is. And it's one that, frankly, the market in its euphoria over the balance sheet fix might be underestimating or even ignoring right now.
So what is it exactly?
This threat stems from a decision by the U.S. government back on August 1st, 2025. They approved placing aluminum lithographic printing plates, ALPPs, under Section 232.
Section 232, that rings a bell. National security tariffs.
Exactly. It's a powerful, somewhat controversial trade law that allows tariffs based on whether certain imports are deemed a threat to U.S. national security. It's been used before on steel and aluminum generally.
Okay, and the result of applying this law specifically to these printing plates?
A massive 50% duty or tariff on imports of those plates.
50%. Wow. And this isn't some minor product for Kodak.
Not at all. ALPPs are the critical, high-volume, recurring blade in their entire print division's razor and blade model. It's the core product, the main revenue generator for that $177 million per quarter print business segment. Remember, print is still 2/3 of their total revenue.
Okay, this sounds really bad, but why is it so catastrophic? Surely they can just source the aluminum they need domestically here in North America and avoid the tariff.
Ah, that is the absolute killer detail, the detail the market might be glossing over. According to Kodak's own CFO, stated publicly, they cannot source the specific proprietary grade of aluminum required for these high-performance plates in North America.
You can't, so you have to import it.
They must import it, often, apparently, from Europe or potentially China, which means a 50% tariff translates directly into an immediate, unavoidable 50% increase in their cost of goods, sold for the single most critical, high-margin product of their largest business segment.
Okay, wait, so that incredible 8 percentage point jump in gross margin we celebrated from the Q3 results,
Yes.
that was based on raw material costs.
Yeah.
Before this massive 50% tariff actually kicks in and flows through their inventory.
Precisely. The strong Q3 operational results, the margin expansion, they do not yet reflect the potential impact of this tariff. This threat is quite literally a ticking time bomb set to potentially detonate on the profitability of 2/3 of the company's revenue base, possibly overnight.
This fundamentally changes the risk profile again, doesn't it? It sort of replaces the just resolved bankruptcy risk with a massive external regulatory risk that management can't easily control.
That's exactly how I see it. The game has changed again. Chapter 7. Conclusion.
Okay, let's try to synthesize this complex, shifting investment narrative for Eastman Kodak now. The bull case seems clear, and it's really centered on that balance sheet transformation.
Right. The $600 million pension cash resolved the going concern risk. It eliminates virtually all their significant outstanding debt, instantly creating a much healthier financial foundation. That's huge.
And the pivot seems real, operationally. AM&C is growing at a solid 15% clip, and that critical cGMP pharma facility is up and operational.
Plus, crucially, management showed powerful alignment and confidence, buying stock personally right at the moment of maximum distress. You have to give them credit for that.
Okay, that's the bull case.
Yep.
But the bear case now seems dominated by that singular, massive external threat.
That tariff, yeah.
Yeah.
The potential 50% tariff on their core aluminum printing plates could, theoretically, negate every single operational and financial improvement they just achieved in Q3. It seriously jeopardizes the fundamental profitability of their largest business segment.
And we can't forget, the company is still relying on a finite cash lifeline. They are still free cash flow negative overall. That $600 million buys time, but it doesn't last forever.
And from a pure market perspective, that immediate 33% stock jump also means the easy money, the quick pop you get just from the liquidity risk being removed, that's likely gone already. The market priced that fix in very quickly.
We established earlier that fundamental valuation now really relies on that complex DCF model, balancing the conflicting growth and decline rates across the two divisions.
Correct. PE is useless. And our educational model, factoring in the debt fix and using a lower discount rate now, suggested that intrinsic value range of roughly $6.50 to $9.50 per share.
And the current market price, yeah, again, is $7.79 per share, sitting almost perfectly in the middle of that estimated intrinsic value range,
It really is remarkably close to the midpoint.
which suggests, as you said, the market has actually been highly efficient here. It successfully priced in the fix, the balance sheet repair, the debt elimination, mainly by lowering its required discount rate.
Seems that way.
But here is the final provocative thought for you, the listener, to really mull over. Has the market, in its rapid repricing of the fix, adequately priced in the massive looming risk of that 50% tariff time bomb? The one that threatens to potentially destroy the profitability of their core legacy print business.
That is the absolute central conflict going forward, isn't it? This is no longer primarily a story about near-term survival. That battle seems won. For now. It's now a much more complex story about whether the new growth engine, AM&C, can scale fast enough and become profitable enough to absorb a potentially catastrophic external shock to its main historical source of revenue and cash flow.
So the due diligence challenge for investors now shifts. It moves away from analyzing the balance sheet liquidity.
And squarely onto assessing regulatory risk and the potential impact of that tariff versus the ramp-up speed of the AM&C business. That's the new battlefield.
That is quite the high-stakes analysis indeed. Thank you so much for walking us through this incredibly detailed deep dive on Eastman Kodak, a true roller coaster.
My pleasure. It's a fascinating case study, that's for sure.
Well, if you found this analysis helpful, if you enjoy these kinds